Hi there, thanks for joining us here at PhillipCapital's Market Watch. I'm Timothy, Research Analyst from Phillip Securities Research. In this episode, we'll be touching on the performance of the FAANGM in January 2022. The FAANGM stands for the big US tech companies, Facebook, Apple, Amazon, Netflix, Google, and Microsoft. In our opinion, it was a painful January as the FAANGM declined and underperformed the S&P 500. The FAANGM declined 7.7% for the month, where the S&P 500 fell 5.9%. The laggards were Amazon and Netflix. Amazon's share price was pressured by inflationary costs, while Netflix was suffering from increased competition and normalizing user growth after a pandemic spike. We remain overweight on the FAANGM as their tailwinds are intact, albeit more selectively. On to the updates on the companies. For Apple, first quarter 22 results were a clean beat. The iPhone beat on volumes and prices, while gross margins were at record highs, despite supply chain issues, demonstrating Apple's pricing power. The outlook for Apple is good. Apple guided for a record second quarter 2022 as supply constraints started to ease, and 2022 is anticipated to have the widest array of product launches. However, it is good to note that there was a slight negative news article regarding a potential delay in Apple's new AR/VR headset. The launch is likely to be pushed back from this June 2022 to 2023 as Apple is facing development challenges. Let's move on to Amazon. The company is experiencing normalizing sales growth after a pandemic-induced spike. Results were in line with forecasts. However, guidance for first quarter 22 sales were up to 6% weaker than the consensus. Amazon's fulfillment network is no longer running at 100% capacity, signaling normalizing demand. However, we are still remaining relatively positive on the company for 2022. FY22 will benefit from easier comparables of 22% revenue growth in FY21 versus 38% in FY20, and operating margins can jump from the eventual easing of fulfillment and labor costs. For Microsoft, second quarter 22 results were firing on all cylinders. Azure, Microsoft's cloud business, grew faster than expected. It is Microsoft's key growth driver at 45% of gross profit growth. Margins were up across all segments from demand for premium licenses for cybersecurity, scaling of cloud infrastructure, and more growth in higher margin businesses. The guidance was for continuation of the momentum. Together with Apple, Microsoft is another FAANG that is seeing better margins despite rising cost pressures from inflation. For Meta, the fourth quarter and full year 2021 results were in line with expectations. Revenue saw 20% year-on-year growth for the quarter and 37% year-on-year growth for the full year. This was led by increases in user growth, ad prices, and ad impressions. However, Meta's stock price was significantly affected by the negative guidance and outlook provided by the company, with concerns over Apple's iOS 14 privacy changes negatively affecting Meta's business model, and increasing competition from TikTok and other social media companies providing additional user acquisition headwinds. Meta also guided to a weak first quarter 22 year-on-year revenue growth of only 3 to 11%. The company also expects total expenditure to increase by at least 26%, led by investments in tech talent and IT infrastructure to better compete in their industry, which should result in a reduction in net margins by at least 6%. Similarly, for Netflix, they posted a strong fourth quarter and full year 2021 results, with revenue up for the quarter 16% year-on-year, and revenue for the full year up 18%. This was primarily led by an increase in both user and subscription prices. At the same time, earnings outperformed consensus estimates, with EPS growing 85% year-on-year for full year 2021 on the back of expanding margins. Even with results in line with expectations, the company's stock price nosedived significantly due to very poor guidance for user additions. The company guided to only 2.5 million net additions for first quarter 22, compared to 4 million additions in first quarter 21. Mentioning a more back-end release schedule and macroeconomic strains in the Latin America region as growth headwinds for user acquisition. Alphabet showed strength in its continued revenue growth for fourth quarter 21 and FY21, posting growth of 32% year-on-year and 41% year-on-year respectively, significantly above its 5-year CAGR of 23%. Advertising revenue was again the main driver of growth, with a 33% year-on-year increase. Google Cloud Services also remained the company's fastest growing segment, with 47% year-on-year growth for FY21 and a significant 51 billion order backlog, signaling a significant demand for its services. We expect the company to continue investing heavily in building up its IT infrastructure to meet this ever-growing demand. Overall, we remain overweight on the FAANGs, with secular tailwinds intact. We raised our target prices for Apple, Alphabet, and Microsoft by 14%, 3%, and 1% respectively after recent strong earnings beats, and upgraded our recommendation for Alphabet to a buy. We lowered Amazon's target price by 2% on slower growth outlook, but remain positive on catalysts from easing labor and fulfillment costs. We slashed Meta and Netflix target prices by 26% and 7% respectively on lower margins and user growth respectively. However, Netflix is upgraded to a buy after its sharp price correction. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you soon.